Welcome to the weekly market view. Once again, I'm joined by Bill Hubard, Chief Economist at markets.com. How are you doing, Bill?
Well, Angus, away from the weather, I guess I'm doing all right.
Yeah, you haven't sort of frozen
yet. Not yet.
Excellent news. So we've had an interesting week, really.
Yes.
Obviously, there's some pretty major events, and this Christmas rally, sort of maybe a bit of profit taking today, but it looks to be sort of underway. What do you think is the key driver behind that? Is it just the time of year or anything specific?
Well, I think one of the things that we have seen is that we have seen most institutional investors, didn't start January and February by investing all their money. They were kind of cautious. So now what we're looking at, especially with interest rates being all negative, what most of them do is want to be, quote, close to fully invested. And one of the things that you've seen is almost the shift out of commodities and commodity-related stocks, whether they be in banks and the good institutional buyers. But again, I don't have to tell you, volume is minuscule.
Yes, of course. It's been a sort of rise on low volume, so there's lots of questions around it. But a lot of economic data today, and let's just touch on UK unemployment figures, which were, again, sort of surprisingly good. Can you give us your view on those?
Well, I think one of the things, and this goes back almost pre-Olympics, when Sir Mervyn King basically said he wasn't so sure about some of the data coming out of the economic formation groups. And one of the things he was talking about was the simple fact of employment. He felt that employment was better. And I think one of the things, and we may have talked about this before, it's happening in the States, and I'm sure it's happening over here, a lot of cottage industries. People that have been cut back, so 2 or 3 friends get together and they start a new business working, in the cottage or working in the kitchen. So I think we are seeing possibly a change in how, whether it be the Bureau of Labor Statistics or the OBR over here, gathers some of this data, especially in reference to unemployment.
So do you think that we could hopefully see that translate into better growth?
I think, and both Sir Mervyn has said it, and I think Carney, who will be coming in the second half of next year, basically inferring that we're doing well here in the UK, but we're still having to be concerned about our brethren across the pond and also in the Eurozone. And Sir Mervyn has been saying that, if we were independent, we'd be doing much better, but the simple fact is we're part of a global economy, we are being affected.
Yeah, of course. Okay, and then so if we move to the other side of the Atlantic, your home country, FOMC, so Ben Bernanke obviously giving a stark warning to the politicians that
Yes.
They need to address this fiscal cliff, but he has definitely made an interesting
Yes.
move there, and so whereby saying that he will not raise interest rates until unemployment is down below 7% or 6.5%. That's a significant move.
Yes.
So do you foresee them raising rates? I mean, how many years out are we going to see that?
Well, first of all, I'd like to wish Ben a happy 59th birthday. And one of the things that, again, Carney coming in talking about looking at, non-inflationary, and using that word growth. Now, the mandate from the Fed, and remember, next February, the Fed will be 100 years old. Their mandate has always been non-inflationary growth. As we saw last night for the first time ever, we have an unemployment figure mentioned, okay? And again, 2.5% inflation, but that's not a problem at all in the States. One of the things to look at is, for the first time, I think in the last 4 meetings, there was no calendar. He didn't designate some specific date or mid-time, although most people feel mid-2015. One of the things we saw, again, the initial claims data today, very positive. And I think one of the things is that the economy did better last month, even discounting Hurricane Sandy. But it's still, the average is only 151,000 for this year, and I think last year was 152,000. So, I mean, if you want to be negative, again, looking forward, if you look backwards, you basically have to say it could take us 41 months in the US to get down to that, quote, 6.5% unemployment rate.
So quite a long way off.
Yes.
Okay. And just finally, so obviously the FTSE just seems to be sort of taking a bit of a pause for breath. We're halfway through December. Do you think, in your honest opinion, that we will see a 6 on the front of the FTSE 100 before the year end?
We may see a 6 within the 4 figures of the FTSE. Now, I would be very surprised if we had any kind of major rally, unless all of a sudden the United States today, tomorrow, or sometime before the 21st said, "Hello boys, Merry Christmas to the global economy. We have solved the fiscal cliff." That would be the only way I could see any major, and it will be institutional buying, okay? Any major institutional buying, and as you say, with a 6 handle. And I'm not trying to be negative, I just can't see that, because a lot of people, remember, Angus, next Thursday, Friday, people are going to start leaving for Christmas, as well as the US Congress. So
we'll have our last one of the year. What a shame. But it will be.
I think our viewers are saying, "Oh, thank goodness."
Yeah, maybe. We'll make it an exciting one.
Exactly right.
Thanks very much indeed,
Angus,
Bill.
thank you.
Okay. Thanks a lot.